Hello investors and traders, welcome to the Trend Trader channel. If this is your first time watching this channel, please consider subscribing. If you enjoyed the content that we are about to share with you now, please consider liking this video and sharing it with as many people as possible, right? In today's video, I just want to talk about stock market investing. The aim of this video is to assist those people that have interest in the stock market, but they don't have an idea what is stock market is investing, what it entails, the risk and benefit of investing in the stock market. I know that a lot of times I always do technical analysis. Some people, they find it useful. Some people, they find it challenging. They say that the content or the concept are a bit complex. It's probably because they are not familiar with technical analysis. But today we are not looking at companies. We're just talking about stock market investing. So there are a couple of things that I'm going to cover in today's video, like what is the stock market, what is stock market investing, the risk of investing in the stock market, the benefit of investing in the stock market, and how beginner investors can approach stock market investing. Everything is in the timestamp. If there's a specific section that you're interested in, you can just go through the timestamps and jump to that specific section that you're interested in. Okay, so what is the stock market? The stock market is where companies go and list. We normally call it there's an exchange, like for example in South Africa we have the Johannesburg Security Exchange, or in the US there's New York Stock Exchange or NASDAQ. So a company, you can start a business. If that business is growing and maybe you need capital to continue to grow your business, then you consider publicly listing your company in that particular exchange. Then once that company is listed, it changes from being a private company. A private company can be owned by an individual or it can be owned by a group of people, but it is not open to outsiders to invest in that particular company. Then once the company is listed in an exchange, then it becomes a publicly tradable. Publicly tradable means that anyone can buy and sell shares of that particular company. So one of the reasons why companies they list publicly is because they want to get that money from investors. Then they can use that money to grow the business, because, well, not everyone has all the money in the world to start their business and grow their business without needing external funding. So that is why companies list in the exchanges or in the public market. Then in the exchange, anyone can buy and sell shares, like I mentioned. Then in order for that transaction to occur, if I want to buy shares in a particular company, we need something that we call a broker. The broker is just an intermediary service between me as a retail investor and another retail investor or an institutional investor elsewhere that wants to buy and sell shares. So the broker facilitates that process. On my side, when I'm buying, the broker is going to try and match my offer price from someone who's asking a specific price. That person would be selling those particular shares. So like I said, the stock market is where the companies, they go to list publicly so that they can access public funds by exchanging equity, meaning that you give that company money, in return they give you some shares, then you own a portion of that particular business, right? So now we've mentioned why companies list. Now let's look at investors. Why investors are interested in the stock market. Now you have money, you want to grow that money. You can start a business, your own business, and try to grow your money. But you can also buy a piece of an existing business, a profitable existing business. Then that is when you go to the exchange to buy companies or to buy shares in companies that you believe that are profitable, or companies that you think that they have a future of being profitable in the long run. The benefit of investing in the stock market or investing in shares is because if the value of those shares rises, then the value of your investment is also going to grow. So people, they invest because they want to get that capital appreciation when the value of the shares that they own, it rises. In addition to capital appreciation, remember we are buying companies, businesses that provide goods and services on a day-to-day basis. Those companies, they can be profitable. Once a company is profitable, after they've done everything, they've consolidated their books, and then they are left with profit, the board of directors of that particular company can then decide to declare a dividend. So a dividend is the portion of money that you get as a shareholder from the profit. Sometimes that money does not always come from the profits alone. You have that a business, it had other assets, and then maybe it's just cutting down, or it's changing the nature of that business. Then maybe they are selling some asset. Then whenever they get that cash, instead of reinvesting that cash in that business, especially if there is no need for them to reinvest that cash in that particular business, then they can take that money and give it back to shareholders. Sometimes those dividends are called special dividends. They happen, they don't always happen. The dividends that happens regularly, they are not guaranteed, is the ordinary dividend, because sometimes you get a question from someone asking that, okay, if I buy a company, can I get a dividend? As a shareholder, you're not necessarily entitled to a dividend. Remember, it's a business. If the business is not profitable, then there won't be money from the business to pass on to shareholders. But if that business is profitable, and then the board decides to pass some of that money to investors, then the company will then declare a dividend. Okay, so now we spoke about the benefit, which are capital appreciation and dividend. With dividends, there are many things that you can do. Whenever you get your dividend, your dividends, you can reinvest them into that particular company that paid them, so that the value of your investment, it grows, and in future the dividends that you'll be receiving will be more than the dividends that you have received initially. Or you can use those dividends to buy other companies, because it's possible that by the time you receive the dividend, maybe you are no longer interested in buying more shares of that company, or maybe it's not the right time for you to buy that particular company. Then you can use that money to buy shares in another business. Just by doing that, you are expanding your portfolio by using dividends for that. But there are some people, especially once you reach old age, if you're no longer having earned income, then some people, they invest in shares with the intention of creating a passive income from the shares that they own. Passive income because they don't have to work, as long as they are invested in particular companies and those companies remain profitable to the point that they are able to give them dividends. Then those people will be earning passive income from their investment. Then it could be a cash flow to do other things, or it could be money that you use to cover your day-to-day expenses. So when can you receive dividends? In South Africa, the companies, they report 2 times per year. So a year could be anything. We're not necessarily talking about January to December. We're just talking about a period of 12 months. According to JSE rules, each company has to give interim dividend. So it's the first 6 months of that year, and then in the last 12 months of that particular year, then they come up with a final result. So either during the interim result or the final result, the company would share the financials of that particular company. They will tell you the revenue, the profit that they generated, if they generated profit, and if there is a dividend that is going to be paid, they will declare that, okay, there is a dividend that will be paying to shareholders. So expect, if you are an investor in a company, expect to receive dividends twice per year from one particular company. Obviously, if you want to receive more dividends, you can invest in different companies. If you want to receive dividends each and every month, for example, you can look for companies that pays dividends each and every month, that you can buy those particular companies. Then you'll be able to receive dividends each and every month. So yes, the benefit is capital appreciation plus that dividend. Then it is up to you as an investor. What do you do with your dividends? Another question is, how much dividend can I receive from a company? Companies are not created equal. The profitability of that company, it depends on which sector that company is operating. If it's operating in a sector that is in a bull market is when the value of the companies or the share prices of the companies, or even the stock market in general, is going up, then we say that we're in a bull market. In a bull market, a lot of companies, they perform well, they pay more dividends regularly, they don't miss dividends because they have enough money. Money is just flowing in, they're able to pay companies. But there are periods which we normally call the bear market, when the stock market is declining. So the value of your investment can decline during a bear market. A bear market, we normally refer to that if it's a general market that is declining. For individual companies, they can just go up or down irrespective whether we are in a bull market or in a bear market, because there are so many factors that can affect a company. If the business itself is not doing great, then other people, they pick up the news that that particular business is not doing well, then there won't be people buying shares. Then there won't be a demand of those shares, and then the share price can decline, or people can just go ahead and sell the shares, and then the value of those companies can decline. So stock market investing is not guaranteed that you are going to make money. It all boils down to the companies that you are picking, right? So now some people then they start to wonder, how am I going to find companies to buy? When that one is the part that sometimes becomes complicated, but I will try to simplify it as much as I can. Selecting a company to invest in is not that difficult. It's not easy, but it's not that difficult. If you are familiar with Easy Equities, you will see that they normally say that invest in companies that you like or that you love. So if you like, say for example, you love People Group, which owns Easy Equities, then you already have a potential company that you can invest in because you like Easy Equities. Then you can just buy People Group. Or if you like ShopRite, because you see ShopRite in your neighborhood, you look at the supermarket, it's always full of customers, month end, people are busy buying, then you think, okay, this should be a healthy business. That's another approach. But that is just the tip of the iceberg. There are things that you need to consider before buying a company. Yes, you still need to look at the profitability of the company. It's important that you understand, because if that business is not profitable, there's nothing that is going to attract new investors that will buy the shares, creating a demand for the shares of that particular company. And also, if that company is not profitable, it means that it won't be able to pay dividends to shareholders. Remember, we're not giving these companies our money out of altruism. We're giving these companies our money because we expect something in return. So other people, they use a concept that is called fundamental analysis. With fundamental analysis, you can look at things like the management of the business. Is the management qualified to run that business? I'm not talking about going to tertiary and getting qualification. Those people, do they have the capacity and the capability to run a business? Then if you are satisfied that the management is capable of running a business, that could be one of the many things that you can look at. And then you look at the nature of the business, where it is operating. What is the competition there? What is the strength of that business? Is this business profitable? Are they able to take your R1 and turn it into something? Then you look at all those things as earnings. Is this company adding more money into developing new products so that they can put in the market, or the product that they already have in the market compared to their competitors? How much of their product is being sold? So those are some of the things that you can look at. It's called a fundamental analysis, right? Personally, I use technical analysis. If you've been watching this YouTube channel, you know that we always look at price action. We look how the price is behaving. Then we try to find opportunities. But for most people, fundamental analysis is adequate because that is something that they understand. Okay, so now let's talk about risk of investing, because now you understand the benefit of becoming an investor. So the risk of investing is that, remember, when you invest, you are putting your money in that company. You are becoming a shareholder, meaning that you co-own that particular company or business. So it's your business. If that business succeeds, then you win. If that business does not succeed, then ultimately you are going to lose money, right? I'm not saying that when you buy a company, your money is just going to disappear. But you need to understand that if the market conditions are tough for that business to operate, then you can expect that business not to do well. If that business is not doing well, the value of the share price is going to decline. If the value of the share price or the share price is declining, then the value of your investment is also going to decline. Let's say, for example, you own 100 shares of ShopRite, and ShopRite you bought the shares at 200 Rand per share. So you would have spent somewhere around 20,000. Just quick math. You can do the maths and satisfy yourself. you put in 20,000 rand, you've got your Shoprite shares. So if the shares go to 210 rand per share, then the value of your investment is growing from 20,000 to 21,000. But if the value of the shares go to 190 per share, then the value of your investment, it also goes down by 1,000. It becomes 19,000. But the number of shares that you're owning, they still remain 100. So now it depends on how you feel about that decline. You can just be comfortable that you still have your 100 shares. It doesn't matter whether the value of your investment is 15,000 or it's 25,000. As long as you still have your 100 shares, then you can sit. But then again, it boils down to your decision. Why did you buy that particular company? What are your expectations with that company? Has anything changed in the business? Something that made you to change your mind, right? Some people, they use a stop loss. I also use a stop loss. If the company declined by a certain percentage, typically by minus 10%, then I'm ready to sell those shares and take that minus 10% loss. Other people are not comfortable with that because the way that they understand their investing does not allow them to take a stop loss, as an example. So the risk is that if the business is not doing well, you cannot expect to make money. It's your business. Nobody owes you anything because it is you that made a decision to invest in that particular company, and you are a shareholder of that particular company. You are with that company through good and bad times. You are not only entitled to good times, right? Then there are times where the value of the company, it just deteriorates. The share price, it just moved from 200 all the way to 100 rand, to 50 rands, to 20 rands. Again, it depends on you emotionally. Can you be able to handle that particular loss? If you can be able to sit down and fold your hands as the value of the shares decline, if you are comfortable with that, you can do it because the number of shares that you own hasn't changed. It's just that it's the value of your investment that has declined. Then the other thing that happens, unfortunately, it does happen. The value of the share price can drop all the way to about 1 cent. It will never reach a zero, because if it's zero, it means that it's either they should just give us those shares for free. But it happens that the company reaches a certain level. Sometimes not just because it's due to the share price dropping. The company can decide that being a publicly listed company is no longer suitable for them. Then they can decide to delist that company. That is not a problem. Whenever a company decides to delist, if they don't see the value of remaining as a publicly listed company, they normally offer the existing shareholders, they offer to buy them out if they want to, because you can still co-own a private company. It's just that it's a bit tricky compared to a publicly listed company, because there are so many rules in the publicly listed company space, the companies that have to comply with. And that's one of the reasons why some companies, they feel like it is no longer beneficial for them to remain publicly listed, right? But it happens that the share price, it just drops to the point that it becomes illiquid. When we say a share price is illiquid, we are saying that it is not easy to buy or sell that particular share. If it happens that you try to put a trade on Easy Equities and then they say maybe you can only invest 500 rand, that is a sign that that share, number one, it's possible that it is illiquid. But it also depends on the broker, because if you try to buy that with broker A, you might find that broker is giving you challenges with buying those shares. But if you buy with broker B, that transaction just goes through. So it's not always about the liquidity of the share. It can also be an effect from the broker. But in this context, we want to talk about the liquidity of the share, not the broker effect that it can have when you want to make transactions. Then when that company is no longer tradable, it can be suspended. Most companies are suspended not because they are illiquid. They are suspended because they are failing to comply with the JSE listing requirement. Like I said, every 6 months, the company has to report to the shareholders what is happening in the business. Is the company making money? Is the company not making money? So now if the company is not reporting, they can request an extension from the JSE that, okay, we are still compiling the results are coming. But there is going to reach a point where the JSE no longer allows them to continue to trade in the exchange because they are failing to provide information to the shareholders. Then the share is suspended. So if you're a shareholder for a particular company and the share becomes suspended, then there's nothing you can do. You can't buy more of those shares, you can't sell those shares, because those shares at that moment, they are not trading on the exchange. It's like they are not there on the exchange. The business still exists, it still does work. The value of your investment is still there. When you log into your broker, you can see the amount that you've invested in that company, but there's no movement. The value is not going up or down. So those are some of the risks. But that is just from the company failing to declare the results that they have, and then GSE end up suspending them. But outside that, if the business itself is failing, then there's nothing that you can do. If the business is failing, it's just failing. It happens. There are companies that are doing great. There are companies that are not doing great. So that is something that you need to keep in mind when you are going to invest in companies, that it's not always going to be a good day. Some days are going to be good, some days are not going to be good. And what can you do to reduce the possibility of losing all the money that you're investing in a particular stock? There's something that is called diversification. So if you buy one company, if that one company does great, you can make a lot of money. But if it performs poorly, you can lose a lot of money. So people, they normally buy more than one company. It doesn't matter how many companies you prefer to have in your portfolio. You can have 1 or 2 or 5 or 10, 20 companies. But if you have more companies, more than one, again, there's no magic number. There's a magic number for you, a number that you're comfortable with. So if you have more than one companies, then some of the companies are going to perform well. Some of them are not going to perform well. So if majority of the companies that are there in your portfolio are performing well, then you can potentially make money by stock market investing, because most of your companies, the share price is growing up, they are paying you dividends, so the value of your investment is growing, despite the fact that there are some companies that are not doing well. Well, it's a bad case if you just end up buying all companies that are going to perform bad, right? So you can diversify to reduce the possibility of losing all your money. But before even you can diversify, you need to make an informed decision. Like I mentioned, that you can do something like fundamental analysis. These days in social media, they call it doing your own research. Whatever that means by doing your own research, before you take your money and buy a particular company, you need to have done a bit of reading, trying to understand the company that you want to invest in, so that by the time you buy that particular company, you know that you are making an informed decision. You have realistic expectations, because another thing that causes investors to fail in investing is because some people, they have unrealistic expectations. You need to understand what is realistic in the market, what is achievable. If you read a lot of financial education books, they talk about over maybe, let's say, 10-year period, the market on average can return between 8 and 12%. So if you go to the stock market expecting to return 100% in a year, that can be an unrealistic expectation. Obviously, there's nothing that can stop you from outperforming the market, but also the other side of the coin is that you can underperform the market. But for you to be able to perform, if you track the market itself, let's say you buy a general market tracking ETF like Satrix Top 40, you are going to get the returns of the market. It's impossible that you can beat the market. Well, there are some ways that you can play around buying and selling that ETF to make money, but if you just buy and hold, you buy that ETF either each and every month, or you buy it at the beginning of the year, then after the 12 months period, most likely you will return what the general market has returned, right? So now you need to have realistic expectations. Don't expect too much from the market, because there isn't much that you can control. You can control which companies you're going to buy. You can control how much of that company you can buy. When you speak of risk management, you can also control how much risk you are taking, either in an individual investment or in your overall portfolio. So there aren't a lot of things that you are in control of. You can't control how the business is going to perform. Whether that business is going to be successful or not, you have no control over that. Whether the management, whatever numbers they are telling you are true or not, you don't have control over that. You can invest in a company only to find out after a number of years that the management were cooking results. Then there's nothing you can do. But at least if you have done your own homework and then you were satisfied with the research that you have done that, okay, this is the best decision for myself, then you can make some money, right? So before we continue, I just want to tell you that we have published a free ebook. The free ebook is available on Gumroad. We're gonna leave the link to that ebook in the description. The name of the book is Simple Guide to Stock Market Investing. It covers some of the things that we've already discussed here, the different asset classes that you can find in the market, the risk and volatility, the relationship between risk and volatility, being a growth investor versus becoming a dividend income investor, and then how you can use the stock market to beat inflation. As we see now, the cost of living is just too high. The income, for those that have earned income, the income is just taking against the expenses. And then there are some resources, because we speak a lot about ETFs, then there's information that can help you with ETF investing. Then lastly, another thing that can help you as a beginner investor. Let's say now you see that, okay, it seems like it's a lot of work to go and research each and every company. There are things that are called exchange traded funds. So ETFs is just a list or bucket of companies that are sold as a basket. Let's say, for example, you're looking at Satrix Top 40. It's all the top 40 companies. Well, let's not talk about Satrix. There are many companies that can sell you a top 40 ETF. A top 40 is an index of the top 40 companies in the JSE. So different companies, they can combine those top 40 companies and sell them to you in one unit as one product. So we call that product exchange traded funds. It's similar to unit trust. There are minor differences. For example, both have the net asset value, which is the value of all the companies in that sector. But like we said, it's an index. So the index has point. If the index has 50,000 points, then you can expect the net asset value of that ETF or unit trust to be somewhere around 50 Rand. The difference is that the exchange traded fund, it's being traded throughout the day when the exchange is open. So you can buy it at 9, you can buy it at 10, you can buy it at 4. But the unit trust, they wait for the market to close to determine the value of the holdings. Then they recalculate the new asset value. So if you place a trade to buy a unit trust, that trade is going to be executed after market. After the market is closed, the net asset value has been determined. Then that's when they're going to sell you the unit trust. The unit trust are mostly used with pension funds, anything where you are putting money besides exchange traded funds. But in the context of retail investors, we mostly trade ETFs. Well, some brokers, they will allow you to trade unit trust, but we mostly trade exchange traded funds. So we have a video. The video is in the description as well, where we spoke about how you can invest as a beginner investor. We covered that you can use ETFs, and then how you can invest as a beginner investor. Yeah, I just want to end this video here because I don't want it to be a too long video, because we already have some of the material in our YouTube channel. So if you check them at the top, you will see a link to that video where we're talking about ETF investing, and then investing as a beginner, whether you're investing a lump sum or you're investing or you're making monthly contributions. And then we also have another video where we speak about how you can use tax-free savings account to get started investing in the stock market. So I hope that in today's video, I was able to share with you what is the stock market, why companies list in the stock market, what are the risks and benefits for investors investing in the stock market, and how people can choose companies and try to manage risk. So yeah, I don't want to go over and over because this video is never going to end. So we're just going to wrap it up here. If you found this content valuable, please consider subscribing if you haven't subscribed. We have more content that is coming, content that will help beginner investors to make informed decisions in the stock market. If you are a returning investor, returning subscriber, or returning viewer, we appreciate you walking this journey with us. Once again, if you enjoyed this content, please consider subscribing. I will see you in the next video.